Today we'll talk about 6 ways you can stuff your Roth accounts. So a quick survey I did recently revealed that about 25% of the content I produce touches on Roth accounts in some shape, form, or fashion. Now I love freedom, and Roth accounts provide it in a unique way by relieving you of all future tax liability for any money you can manage to get into a Roth IRA, 401k, or other Roth type retirement account. Now for those of you who aren't familiar with Roth accounts, they allow you to save money for retirement that grows completely tax-free. All earnings and future withdrawals do not have any tax obligations whatsoever, unless you have an insanely large estate. The catch is other traditional retirement accounts save on a tax-deferred basis, meaning the contributions and earnings can grow for years without being hindered by taxes. In these accounts, taxes are owed upon withdrawal. So with a Roth, you pay tax on the front end. With a traditional account, you pay tax upon withdrawal. And even though the government is happy to aid you in your retirement saving efforts, there is a limit to their generosity. So for example, Roth IRA contributions are limited to $7,000 in 2024. It's actually $8,000 if you're 50 or older. And other Roth accounts come with contribution limits as well. But as they say, where there's a will, there's a way. In the case of Roth accounts, there are 6 ways you can stuff more money into your Roth accounts that I'd like to share with you now. The first one is just to contribute directly to a Roth IRA. The max contribution you can get in this route is $7,000. It goes up to $8,000 if you're 50 or older. If you have earned income, that's income that is subject to Social Security tax. It's a quick way to identify that. Then you can contribute directly to a Roth IRA up to the annual contribution limit or your modified adjusted gross income, whichever one of those numbers is lower. Now we have the 2024 contribution limits on your screen. I'd like to point out a couple of noteworthy things about the table. The first thing you'll notice is there are income limitations for direct contributions to a Roth IRA. Depending on your filing status, the amount you can contribute begins to phase out before disappearing altogether. Now there are ways around this limitation, which I'll discuss in more detail later. The other noteworthy point is that once you reach age 50, you get to contribute more to a Roth IRA. This is called a catch-up contribution, and though it may not seem like a bunch, it's only $1,000. It's almost 15% more than you can contribute before you turn 50. The 15% is not an insignificant amount. If you're able, you should take advantage of it. Also, you may not think that contributing to a Roth IRA alone is enough to fund a satisfactory retirement, and satisfactory is certainly a subjective term, but contributing to the annual limit can grow to an impressive amount of money. So for the fun of it, I ran a scenario to see how much I would have in a Roth IRA if I contributed up to the annual limit every year since 2007. That's when I started investing. I assumed an annual rate of return of 8%. The total came out to $214,107. That's really not bad after 17 years. Now the balance was allowed to continue to grow without another penny of contributions. It would hit $1 million in 2024, which was 37 years after I started, or 20 years after I'm recording this video. All right, method number 2 is to contribute through a backdoor Roth IRA. Again, the max contribution for this route is $7,000 or $8,000 if you're 50 or older. Now earlier we had a table on your screen that showed you the income limitations for Roth IRA contributions. You may have looked at that and realized that you have the not so bad problem of making too much money to contribute directly. And maybe you've also noticed that I've used the word directly like 3 or 4 times now. Well, that's because there's an indirect way to still put money into a Roth IRA, but it does take an extra step, and there's a major tax hurdle you may or may not have to clear. It's called a backdoor Roth IRA, and here's how it works. Now, while there are limitations for tax-advantaged IRA contributions based on income, that means tax-deferred or Roth, anyone can make contributions to an IRA on a non-deductible basis at any time. Now, most people don't bother because why would you tie your money up in a retirement account with an early withdrawal penalty without also getting a tax deduction for it? However, there is a sort of loophole / open door in the tax code. It's actually been there for 14 years now that allows anyone to convert those same non-deductible contributions to a Roth IRA. Now, you will owe income tax on any earnings when you make the conversion, but if you do the conversion right after you've made the contribution, there won't be time for many earnings to accumulate anyway, so you won't owe much tax. So step 1 is to contribute to an IRA on an after-tax basis. Step 2 is to convert that contribution to a Roth. It's pretty simple, right? Well, there is a potential kink to throw into the works. The IRS requires that all conversions be taxed on a pro rata or proportional basis of all the non-Roth IRA funds you have in all of your IRAs. So for example, let's assume you have a tax-deferred IRA balance of $20,000 and you want to contribute and convert $5,000 through a backdoor Roth IRA. Now, if you do that, you'll owe tax on 80% or $4,000 of the converted amount because 80% of your non-Roth IRA assets haven't been taxed yet. So if you have a large tax-deferred IRA balance, the backdoor Roth IRA strategy may not be worth it. Now, one potential workaround is to roll your IRA into an employer-sponsored retirement plan like a 401k, as if your plan allows. That way you move the money out of the Roth IRA, leaving only after-tax contributions, thus reducing or eliminating your tax liability altogether. The third technique is to contribute directly to a Roth 401k, 403b, TSP, or 457. The max contribution for that in 2024 is $23,000 or $30,500 if you're age 50 or older. Years ago, an IRA was the only way to get money into a Roth account, but in 2006, legislation was introduced allowing Roth contributions within employer-sponsored plans like 401ks, 403bs, 457s, and TSPs. It did take some time for employers to adopt Roth options, but now over 85% of employer-sponsored plans are available as a Roth. And one of the primary benefits of using an employer-sponsored plan is the extra contribution space they provide. As you can see in the table, employer-sponsored plans enjoy far more room for contributions than IRAs. In 2024, you can contribute up to $23,000 to an employer-sponsored plan and up to $30,500 if you're age 50 or older. And Secure Act 2.0 paved the way for employer contributions to also be made on a Roth basis if your plan allows. Now, if you do elect to have your employer contributions made on a Roth basis, you do need to keep in mind that you will owe income tax on those contributions. Also, Secure Act 2.0 was originally written to require higher income individuals, that's with adjusted gross income over $145,000, who are making catch-up contributions, that's age 50 and older, to do so on a Roth basis only. So that space between $23,000 and $30,500, originally legislation required higher income individuals to make that on a Roth basis only. That's the only way you could do it. However, when Congress wrote the law, they did it in such a way that they accidentally made it impossible to legally make catch-up contributions for anybody. Big mistake. There's also been a bit of an outcry around this requirement and the administrative burden that it will create for plan management, actually rising costs. So those forces together combined to persuade Congress to actually delay this requirement until at least 2026. Personally, I think the administrative burden is going to be so high that they're just going to take it out of the law entirely. So stay tuned. Speaking of staying tuned, if my videos are helpful to you, please consider showing your appreciation by clicking like below and subscribing to our channel. When it really comes down to it, that's how we gauge how helpful our content really is. It also helps our channel to grow and allows me to keep making content so I can help people learn about personal finance. Method number 4 is to use a mega backdoor Roth. Now in this scenario, your max contribution could be $69,000 or $76,500 if you're age 50 or older. So I just highlighted how employer-sponsored plans provide a much larger space for retirement saving than IRAs. That's $23,000 versus $7,000 if you're under 50. Well, the $23,000 tax advantage employee contribution limit is only part of the story. In 2024, combined contributions by employees and employers to an employer-sponsored retirement plan are capped at a whopping $69,000 annually, and that goes up to $76,500 for those who are age 50 or older. So to clarify, you can contribute up to $23,000 in 2024 as an individual. In addition to your individual contributions, your employer can contribute up to $69,000. Now in most cases, employers do not contribute enough to fill in this gap, so it goes unused. However, if your plan allows, you can contribute up to this upper threshold, that $69,000 or $76,500 limit on an after-tax basis or a non-deductible basis, then convert it to a Roth contribution. These steps are very similar to the backdoor Roth IRA we discussed just a minute ago. Now, using this method, you could potentially get up to $69,000 into a Roth 401k in 2024 or Roth 403b, 457, whatever, and up to $76,500 if you're age 50 or older. That is a whole lot of Roth. Furthermore, if your plan allows, you can make an in-service distribution to a Roth IRA, which effectively allows you to move these huge sums into a Roth IRA that you control completely. Now, I do want to take a second and draw special attention to the words, if your plan allows. Not all employer-sponsored plans are created equally. Some plans allow after-tax contributions, some don't. Some plans allow conversions to Roth, some don't. Some plans allow in-service distributions, some don't. The bottom line is your employer has the option to make your plan as flexible or as rigid as they wish. You'll need to check with your employer or read the summary plan description to find out what your options are. Option number 5 is a solo Roth 401k. Max contribution here is $69,000 again and $76,500 if you're 50 or older. Now we just talked about employer-sponsored retirement plans. I want to quickly highlight solo 401k plans because they provide a unique saving option for sole proprietors. Now the rules and contribution limits for solo 401k plans are basically the same as regular 401k plans, but solo plans provide a unique saving option. If you have access to a 401k plan where you work and you also own a business in which you and or your spouse are the only employees, then you can contribute to a solo 401k in addition to your plan at work. This effectively gives you double 401k saving space. And if your spouse works in your business, then he or she gets a contribution too. That's 3 401k plans worth of saving space. Now, as usual, there are a couple of caveats. First, you only get one cumulative individual contribution to all the 401k plans you have access to. That means if you're under 50, your total tax-advantaged employee 401k contributions cannot exceed $23,000 in 2024, period. However, as the employer, you can contribute the full $69,000 limit to your solo 401k. So this isn't as big of a problem as it might sound initially. And most folks take the employer match from their place of employment, and then they make employer contributions to the solo 401k for whatever else they want to save. Also, unfortunately, this double plan option is only available if you have a 401k at work, not a 403b. I have no idea why that rule exists, but it does. Method number 6 is conversions to a Roth IRA. The max contribution here is unlimited. We've already touched on Roth conversions, but I want to highlight the fact that there are no limitations on how much you can convert to a Roth IRA. With that said, all conversions are taxable events, and they are subject to your marginal or highest tax bracket. So not only do you owe tax when you make the conversion, but if you convert so much that it pushes you into higher tax brackets, then the conversions begin to lose their luster a bit. But even so, conversions can be very helpful for a few reasons. So first off, you can use your conversions to access IRA money early through a Roth conversion ladder. I won't take time to provide a detailed explanation now, but in summary, Roth conversions are eligible for penalty-free withdrawals 5 years after each conversion. And many people use this strategy to fund an early retirement. We actually have a video about Roth conversion ladders. I'll put a link above. Another popular use of Roth conversions is tax arbitrage. If you contribute money to a retirement plan while you have a high income, odds are you'll want to take the tax deduction for those contributions. But once you retire and your income is lower, you may want to convert your savings to a Roth IRA in a tax year when your marginal tax rate is low. That way you've avoided higher taxes when you made contributions while also giving yourself the option of paying them when it's convenient. Another great reason to make Roth conversions is to avoid large required minimum distributions from tax-deferred accounts when you reach that age. RMDs will remove the control you have over when you pay taxes once you reach age 73 or 75. It depends on when you were born. It may pay for you to convert much of your tax-deferred money before you lose that control. Conversions do tend to be most helpful for retirees, but I cannot overstate the potential value they provide. I'd encourage you to take time to understand how they work. We have several other videos and posts about conversions. We'll put those down in the description below. All right, method number 7 is to invest aggressively. The max contribution here is unlimited, but it's not really a contribution. It's more about maximizing the earning potential of your Roth accounts. And using modern portfolio theory as a guide, most investors these days are thoughtful not only about their asset allocation, but also where they hold certain assets. It's also known as asset location. Now, the reason they do this is because, as we've already seen from this video, different accounts receive different tax treatment. So, for example, if you're trying to avoid ongoing taxes from your taxable brokerage account, you should probably avoid holding bonds or dividend stocks in those accounts because they'll regularly distribute earnings or yields that are subject to tax. And since Roth accounts enjoy completely tax-free growth, it makes sense to hold your investments with the highest earning potential in a Roth account. Now, typically, these are also going to be your riskiest assets, so you should have a long runway before you need these funds. The good news is Roth accounts are also typically the last accounts you want to reach into when you begin distributions in retirement, so it makes a lot of sense to allocate your growth assets into Roth accounts. Meanwhile, you can place more conservative investments like bonds or cash equivalents in your tax-deferred accounts, so you receive the same portfolio steadiness you would from a thoughtful asset allocation, but as it grows where you want it to grow the most, in the Roth, tax-free. Now keep in mind, as you begin your drawdown from your retirement funds in retirement, you don't want to hold aggressive investments in your Roth if that's money that you're going to need in the next 5 to 7 years. Again, it's long-term money for aggressive investing. If it's money you need in 5 to 7 years, you won't have time to recover from an economic downturn, so it makes more sense to hold safer investments like treasuries in that window. I've actually made an argument that you shouldn't hold 100% of your money in a Roth account, but you might as well get pretty dang close. I've never heard anyone complain about having too much tax-free money in a Roth. I do hope this information was helpful to you as you try to direct as much money as you can into your own Roth accounts. As always, we are super grateful for your time and interest in our videos. God bless and take care.